Well, my take on the FOMC minutes is that they will ultimately prove to be a hard pill for investors to swallow. And the reason why I say that is that for the last 2 years, financial markets have risen on the tailwind of the Federal Reserve printing a ton of money and injecting it into financial markets. What the minutes make very clear is that the Federal Reserve is going to run that machine in reverse. They're going to allow their balance sheet to shrink. They're going to unprint money, and they're going to unprint money at a much faster pace than the last experiment in unprinting in 2017 and 2019. That means, whereas for the last 2 years, financial markets have been able to count on increasing liquidity every month as the Fed's printing press rolled, they're now going to see decreasing liquidity every single solitary month. And that decreasing liquidity is going to come in $95 billion chunks. That's how much they're unprinting each month. Put that in context, that's almost twice the pace that the market endured in 2017, 18, and 19. In 2018, we saw a fairly substantial market correction in the back half of the year. In 2019, the bond market actually buckled under the combined weight of the Fed's unprinting and the trillion-dollar budget deficits of the Trump administration. And the Fed actually had to reverse course and start printing money in September of 2019. So this means for investors, you probably need to stop worrying quite so much about inflation. The Federal Reserve is very clearly going to be focused like a laser on getting inflationary pressures down. Now you need to start worrying that liquidity is going to be drying up. What will that mean for asset prices and valuations?